Hey everybody, this is problem 9-3A, or at least that's what it's called in your homework. This is the B version of it, so it's a little different, but the same concept. Anyway, I had a student ask some questions about it, so I thought I would go through and work it out for you, and hopefully it will be of help to several of you. So here we go, 9-3B version. It says, here are the selected transactions for Evans Corporation for 2014. On January 31st, they retired a piece of machinery that was purchased on January 1st, 2004. Machine cost $47,000, had a useful life of 10 years with no salvage value. Then on March 31st, they sold a computer that was purchased on January 1st, 2011. The computer cost $43,400 and had a useful life of 7 years with no salvage value. The computer was sold for $25,000. And then finally, December 31st, discarded a delivery truck that was purchased on January 1st. The truck cost $30,000 and was depreciated based on a 6-year useful life with $3,000 salvage value. All right. Then the instructions say journalize all the entries required on the above dates, including entries to update depreciation on assets disposed of. Where applicable, Evans Corporation uses straight-line depreciation. So the first step for these kinds of problems is to figure out the amount of our entries. And then the second step, of course, is to figure out which accounts are being impacted. So let's just take these one at a time. On January 31st, so they retired a piece of machinery. It had a cost of $47,000. It was purchased 10 years before, and it had a useful life of 10 years with no salvage value. That means that this piece of machinery was completely depreciated at the end of its useful life. So we're going to have to depreciate the total cost of the machinery. So that is $47,000. So our journal entry on January 1st is going to involve some debit and some credit of the total amount of $47,000. So what we have to think about here is now what accounts are being impacted. And in the first case, the account being impacted is, well, I'm trying to think of a better way to put this. So what we have is an asset sitting on our books. Remember, when we buy and record assets, we record them at our cost. So we have an asset called machinery or something like it that is sitting there with a $47,000 balance on our books. We also have an accumulated depreciation account that's linked to that machinery account sitting there on our books with a balance of $47,000 because we've fully depreciated the asset. And like I said, it could be called machinery, it could be called equipment, something like that. So what we have to do if we're disposing of the asset is we have to get rid of those accounts. So the asset account, equipment, is going to have a debit balance. So we're going to have to do a credit entry equal to that balance in order to make the asset zero, so it's no longer on our books. The accumulated depreciation account on the equipment or machinery is going to have a credit balance of $47,000. So we're going to have to do a debit entry to get rid of that account. That's what happens when we dispose of an account. We want to get rid of it. So the journal entry will look something like this. Accumulated depreciation on the equipment, $47,000, and the equipment, $47,000. So there's our first entry, and that entry again is to get rid of that asset and its accumulated depreciation account. And since it was fully depreciated, that was pretty easy. So on March 31st now, we have sold a computer that was purchased on January 1st, 2011. The computer cost $43,400 and had a useful life of 7 years with no salvage value. So the computer was sold for $25,000. So we've got a bunch of things going on here. Okay. The first thing we have to do is make sure we record the appropriate depreciation for this year. So from January 1st, at the beginning of this year, up until the date we sold it, which is March 31st. So that's step one. So that's going to be an entry that involves depreciation expense and accumulated depreciation. The way we figure out the amount is we have to calculate the amount of time that has happened from the beginning of the year, January 1st, to the date we sold the computer, March 31st. So that is 3 years. So we will figure out the amount of depreciation then, since it was straight line. We'll say we can recognize a couple things. I'm just going to make some little notes over here. So our cost is $43,400. Just using this as a little notes area. Our useful life was 7 years. Salvage value is 0. So we know then that 1 year's depreciation would be equal to the cost of $43,400 minus the salvage value of 0 divided by 7. So this will equal $43,400 divided by 7. So we know that there's $6,200 worth of depreciation for each year of the computer's useful life. We further know that during the current year, so during 2014, we will have experienced all of January, all of February, and all of March, 3 months. So 2014 depreciation is going to equal 1 year's worth of depreciation, 6,200, times 3/12, or 3 months out of 12. That would also be 1/4, right, or 25%. So we have $1,550 worth of depreciation that we have to enter in order to record our depreciation expense and our accumulated depreciation for January 1st through the March 31st. And I'm going to put note to record depreciation on computer sold, or something like that. Okay, so in addition to this happening, we also have some other entries happening. For one, our cash went up, right? We sold it for some cash, so we had an increase to cash of $25,000. For another, we have to get rid of the accumulated depreciation account, because that's what we do when we get rid of an asset. We get rid of the asset account and its linked accumulated depreciation account. So we're going to have to figure out a balance in that account, because it's not given to us, to know how much we've got to deal with here. And like I said, we've already figured out what 1 year is. So this was purchased 2011. So we're going to have depreciation for 2011, 2012, 2013, and 2014. Since it was purchased on January 1st of 2011, that means 2011 had a full 12 months worth of depreciation, which we already figured out up here was $6,200. 2012 would have had the same. 2013 would have had the same. And we know that 2014 had $1,550. We know that because we just made the entry for it. So our total accumulated depreciation at the point of sale should be $20,150. All right, well, it didn't sound like it to you, but I had to take a break there for about 20 minutes to meet with another student. So if I sound a little confused, I'm hopping back into the middle of this problem after having been away. It's probably something all of you can identify with as you try to do homework and you have children and roommates and all sorts of other things to deal with. Anyway, so I'm back, even though you didn't know I was gone. Anyway, so I'm back. I'm on accumulated depreciation for the computer. I calculated over here a full depreciation for 2011, 2012, 2013, 2014. So a total accumulated depreciation balance of $20,150. I know that accumulated depreciation accounts have a balance on the debit side, so I have to do a credit entry in that amount, $20,150. And that effectively makes the accumulated depreciation account go away because I've just debited an amount equal to the credit balance. The next thing I have to do is I have to get rid of, so to speak, the asset. And so the asset, if you remember, is going to be carried on my books at its cost. So I'm going to and sometimes they would list this instead of as computer as just equipment as well, but I'm calling it computer. So I would have a debit balance in my computer account of $43,400 because that was the cost of the computer. So now I have to credit that account $43,400 to get rid of the computer, or to, whoops, not 434,000, 43,400 to get that account off my books. At this point, you're going to recognize that I got some cash, that I got rid of my accumulated depreciation, and I got rid of my computer, but these don't balance. You can see that these two add up to $45,150, and the computer asset adds up to $43,400. So in order to make this whole thing balance, I'm going to have to do a debit entry that will make the debit and credit sides of this entry, I'm sorry, I have to do a credit entry that will make the debit and credit sides add up. So if I've got $45,150 on the debit side, and I have $43,140 on the credit side, that amount would be, let's find out, $45,150. I'm using a calculator off screen that you can't see, minus $43,400 gives me a balance of $1,750. And that $1,750 is going to represent the gain on the disposal of the asset or of the computer. Again, I'll double check that my debits, $45,150, and my credits, $45,150, equal each other for this transaction. So that's what it will look like. Cash to show the cash I received from selling the computer. Accumulated depreciation to close out the accumulated depreciation account for the computer. We calculated that by figuring out how much the balance of that account should be, which should be full depreciation for 3 years, 2011, 12, and 13, and the partial depreciation for 2014, which we calculated earlier. Then we have a credit entry to close out our computer account, so that's equal to the debit balance, which was our cost of the computer, and then the difference, which would be a gain. If I had to put a difference over in the debit side, let's say these numbers were less than the number on the computer side, I'm sorry, on the credit side, then that would be a loss. The way I remember this is that debit entries are expenses and credit entries are revenue, or that's where we usually enter those types of entries. So to make it all balance, I have to add to the credit side. That's going to be a gain or on the sale of the computer. All right. So finally, December 31st. So we discarded a delivery truck that was purchased in January, on January 1st, 2011. The truck cost $30,000 and was depreciated based on a 6-year useful life with a $3,000 salvage value. So again, they purchased this 3 years ago, but they had a 6-year useful life, meaning it isn't fully depreciated yet. So I'm just going to use my little work area again over here. We'll delete all these things. And we'll say the cost of that truck was $30,000. The useful life of the truck was 6 years. The salvage value of the truck was $3,000. So 1 year worth of depreciation then would equal the cost minus the salvage value divided by the useful life. So this truck will depreciate at a rate of $4,500 per year. Same thing, we need to figure out how much depreciation happened during 2014. So from January 1st, 2014 to December 31st, 2014 is a full year. So we had one year's worth of depreciation. So that would be $4,500. It's a whole year's worth. Okay. All right. So since this was purchased January 1st, 2011, we would have had $4,500 worth of depreciation, a full year's worth in 2011, $4,500 in 2012, $4,500 in 2013, and a full $4,500 in 2014, or $18,000 total would be in the accumulated depreciation account. Okay. So the first entry we have to do is the depreciation for 2014. So it'll be depreciation expense, $4,500, and accumulated depreciation, and that should say accumulated depreciation of the truck. Oops, spelled it wrong there. Then we have to do the entries to recognize, let's see, we didn't receive any cash, right? We discarded the truck. So we didn't receive any cash for the truck, so our cash doesn't go up. We still have to get rid of the accumulated depreciation for the truck or close that account out. That closeout is going to be equal to the balance of the accumulated depreciation account, which is $18,000. Remember, that would be a credit balance, so we're going to do a debit entry. I'm going to leave a blank space because I have a feeling we're going to need it. Well, let's just say I don't know it. I'm just going to go ahead here. The second thing I need to do is get rid of the asset. So my truck asset would have had a balance of the cost of $30,000 on the debit side. So we're going to credit that $30,000. And now we're going to see there's a difference between the two, right? They don't balance out. So you'll see, if you remember on the last one, we had cash, then we got rid of or closed out the accumulated depreciation and got rid of or closed out the asset computer. Here we didn't have any cash. We did close out accumulated depreciation and we closed out the asset, and there's a difference of $12,000 between the two of them. And that difference is going to have to go on the debit side, right, to make the whole transaction balance. So it's going to be $12,000. Now we balance. We have $30,000 on either side. And again, the question is, what is it? So down here, when we had to add to the credit side to make it balance, we called that a gain on the disposal of the computer. Here, we're going to call this a loss on the disposal of the truck. And that is the entry, and that's the whole problem. So hopefully this video helped explain kind of how we walk through it. As always, if you have any questions, please let me know, and have a great day.